Imagine walking into a bank with little savings, uncertain income, and still walking out with approval for a home worth hundreds of thousands of dollars. For millions of Americans, that wasn't a dream, it became reality. During the early 2000s, buying a home seemed easier than ever before. House prices kept rising, banks kept lending, investors kept buying mortgage securities, and everyone appeared to be making money. At the center of this extraordinary housing boom stood one company, Countrywide Financial. Founded in 1969, Countrywide grew from a small mortgage lender into America's largest home loan company, originating hundreds of billions of dollars in mortgages and helping millions of families finance their homes. To many Americans, Countrywide represented opportunity. To Wall Street, it represented an endless supply of mortgages, feeding one of the fastest-growing financial markets in history. The more loans Countrywide created, the more money flowed through the financial system. It looked like a machine that could never stop. But hidden beneath the rapid approvals, record profits, and soaring homeownership, one critical assumption held the entire system together: that American house prices would keep rising forever. Countrywide wasn't becoming America's largest mortgage lender simply because more families wanted homes. Something much bigger was happening behind the scenes. For decades, banks had typically issued mortgages and collected monthly payments for the next 30 years. That meant every new loan tied up the bank's money for decades. Growth had limits. Then Wall Street changed the rules. Investment banks discovered they could purchase thousands of individual mortgages, bundle them together into mortgage-backed securities, and sell those securities to investors around the world. Suddenly, a mortgage wasn't just a home loan anymore. It became a financial product. When Countrywide approved a mortgage, it no longer had to wait 30 years to recover its money. Instead, the loan could be sold almost immediately. That money returned to Countrywide, which meant another mortgage could be approved, then another, then thousands more. The faster mortgages were created, the faster they could be sold. And the faster they were sold, the more money flowed back into the system. For Wall Street, more mortgages meant more securities to sell. For investors, those securities appeared to offer attractive returns backed by American homes. For Countrywide, every approved loan became the raw material feeding an industry that suddenly couldn't get enough mortgages. Homes were no longer just places for families to live. They had become inventory for a financial machine that demanded constant growth. The new mortgage machine had one problem. Wall Street wanted more mortgages than America had qualified borrowers. For years, traditional lending had followed one simple principle. Before approving a loan, banks carefully verified income, employment, savings, and a borrower's ability to repay. That process limited growth. Countrywide discovered a faster path. Instead of asking, "Can this borrower safely repay the loan?" the industry increasingly asked, "Can this loan be approved and sold?" Mortgage brokers were paid for originating loans. Countrywide earned fees for producing them. Investment banks earned money packaging them into securities. Credit rating agencies earned fees rating those securities. Investors earned returns buying them. Every participant in the system benefited when more mortgages were created. Very few benefited from saying no. As competition intensified, underwriting standards continued weakening. Low documentation loans became common. Borrowers could qualify with little proof of income. Some loans required no verified employment. Others required no meaningful deposit. Some became known as ninja loans: no income, no job, no assets. Adjustable rate mortgages offered low introductory payments that made expensive homes appear affordable. Many borrowers believed rising house prices would allow them to refinance before higher repayments ever arrived. Lenders believed they would sell the mortgage before any long-term risk appeared. Investors believed sophisticated financial engineering had made the securities safe. Rating agencies believed the probability of widespread housing declines remained extremely low. Almost everyone believed someone else was carrying the risk. In reality, the risk had never disappeared. It had simply been spread across an increasingly fragile financial system. And the entire system still depended on one assumption: that American house prices would never stop rising. For years, the entire mortgage machine depended on one simple belief: that American house prices would continue rising. As long as prices increased, borrowers who struggled with repayments could refinance into new loans. Banks avoided major losses. Mortgage-backed securities continued performing, and investors remained confident. Then the housing market slowed. In many parts of the United States, house prices stopped climbing. Soon after, they began falling. For millions of homeowners, everything changed. Adjustable rate mortgages that had started with low introductory payments began resetting to much higher interest rates. Monthly repayments suddenly increased. Many borrowers discovered they could no longer afford their homes. Under normal circumstances, they would have refinanced. But falling house prices created a new problem. Many homes were now worth less than the mortgages attached to them. Borrowers had little equity. Many no longer qualified for replacement loans. Defaults began rising across the country. Foreclosures increased. Entire neighborhoods filled with abandoned homes. As more houses entered the market through foreclosure, prices fell even further. The housing market entered a self-reinforcing downward spiral. The mortgages flowing through Countrywide's production machine no longer looked like valuable financial assets. They became growing sources of loss. And the securities built upon those mortgages began losing value across financial markets around the world. The assumption that had powered years of extraordinary growth had finally broken. As mortgage defaults accelerated, Countrywide faced a crisis far more dangerous than rising loan losses. The financial machine that had fueled its extraordinary growth suddenly stopped working. For years, Wall Street had eagerly purchased billions of dollars of newly originated mortgages. Now, investors no longer trusted the securities built upon them. Demand collapsed. Without buyers, Countrywide could no longer sell mortgages as quickly as before. That meant billions of dollars remained trapped on its own balance sheet. At the same time, financial markets became increasingly nervous about lending to mortgage companies. Countrywide depended heavily on short-term funding to keep originating new loans. As confidence disappeared, that funding became harder and more expensive to obtain. The company's liquidity position deteriorated rapidly. Then the broader financial system began breaking apart. In 2008, Bear Stearns collapsed. Confidence across global credit markets deteriorated even further. Months later, Lehman Brothers filed for bankruptcy, triggering one of the worst financial panics in modern history. Banks stopped trusting each other. Credit markets froze. Investors rushed toward safety. Countrywide was now trapped between collapsing mortgage values, disappearing investor demand, and rapidly tightening access to funding. The company that had once supplied America's housing boom had become one of its largest casualties. In January 2008, Bank of America announced it would acquire Countrywide in an attempt to stabilize the rapidly deteriorating mortgage lender. The acquisition prevented an immediate collapse, but it could not prevent the damage that Countrywide had already helped unleash across the global financial system. Countrywide's collapse wasn't the end of the story. It was one piece of a much larger financial chain reaction. As mortgage defaults continued rising, the securities built upon those mortgages rapidly lost value. Banks around the world suddenly discovered that assets they believed were safe had become extremely difficult to price. Some institutions didn't know how much those securities were actually worth. Others didn't know which banks were carrying the biggest losses. Confidence disappeared. Banks became increasingly reluctant to lend money to one another. Credit markets slowed. Businesses struggled to borrow. Consumers found it harder to obtain loans. What had begun as a housing problem was becoming a global financial crisis. Governments and central banks were forced to intervene on an unprecedented scale. Emergency lending facilities were created. Interest rates were rapidly reduced. Massive financial rescue programs were introduced to stabilize banking systems. In the United States, millions of families lost their homes through foreclosure. Entire communities experienced falling property values. Construction companies failed. Unemployment increased. Economic activity slowed sharply. The crisis spread far beyond American borders. Banks across Europe reported enormous mortgage-related losses. Financial markets around the world entered recession. The International Monetary Fund later estimated that global financial institutions suffered losses exceeding $1 trillion during the crisis. Countrywide hadn't caused the housing bubble alone, but it had become one of the largest engines supplying the mortgages that allowed the bubble to reach extraordinary size. When that engine failed, the consequences reached almost every corner of the global economy.
Countrywide Financial disappeared, but the system it helped build changed banking forever. In the years that followed the financial crisis, governments concluded that the mortgage market had become dangerously dependent on one assumption: that continuously rising house prices could compensate for weakening lending standards. That assumption no longer survived. The United States introduced sweeping financial reforms designed to strengthen oversight across the banking system. The Dodd-Frank Act imposed stricter regulation on financial institutions. Mortgage lenders faced significantly tighter underwriting requirements. Borrowers now encountered far more rigorous income verification, affordability assessments, and documentation standards before receiving home loans. Banks were required to hold more capital against potential losses. Mortgage-backed securities became subject to greater transparency and stronger risk management. The era of approving loans first and asking questions later had largely come to an end. Countrywide itself disappeared into Bank of America. What initially appeared to be a rescue quickly became one of the most expensive acquisitions in banking history. Bank of America spent years dealing with lawsuits, regulatory settlements, and mortgage-related liabilities linked to Countrywide's lending practices, ultimately paying tens of billions of dollars to resolve claims arising from the crisis. Countrywide's co-founder and CEO, Angelo Mozillo, became one of the most recognizable faces of the housing collapse. Although he avoided criminal conviction, he reached major civil settlements with regulators over allegations related to investor disclosures and his role during the housing boom. The collapse wasn't caused by one reckless borrower, one careless lender, or one investment bank. It happened because nearly every participant in the system benefited while house prices continued rising. Borrowers gained access to larger homes. Lenders generated more loans.
Wall Street created more securities, investors earned attractive returns, rating agencies collected more fees. Almost nobody had an incentive to slow the machine until reality did it for them. Countrywide didn't simply finance the American housing boom, it industrialized it. And when the foundation beneath that machine finally cracked, the consequences reshaped banking, regulation, and global finance for an entire generation. Because financial systems usually don't fail when people stop believing. They fail when incentives reward growth long after caution has disappeared.